Hey everyone, Chris and Terrance here. Welcome to the Multifamily live Q&A session here on YouTube.
Q&A, let's go.
Yeah, so people on YouTube, start putting your questions in the comments below. We'll be chatting or monitoring those and answering those. But Terrance, you got a couple questions off of LinkedIn, was it?
Yeah,
I think.
LinkedIn, we had some on Instagram. So we're going to highlight a few of them that we thought were interesting and relevant to what we're talking about.
So this one's from Jack. Jack says, really enjoying the live Q&A, but can't make the show time. I was hoping I could toss you and Chris a question for the show. I have a buy and hold model, and once the portfolio cash flow reaches 20% of the next down payment on the next building, I will leverage that into another building. Given this trajectory, I will eventually become over leveraged, and even good debt will become bad debt. My question is, what is a good debt to income ratio in multifamily investing? Is that the best metric to use when deciding whether to leverage cash flow into another property or pay down principal and interest in other buildings? Show is awesome. Thank you, guys. That's a really good question.
Jack, very well thought out question. The punchline in my mind is you never want to have bad debt. Bad debt is when you're buying things like boats, watches, shoes. Good debt is when you take money from the bank at 4 or 5% and invest it in properties that create 7, 8, 9, 10% of cash flow in a return. So that's good debt. That's arbitrage. You're taking money at a lower interest rate, investing it at a higher interest rate. So I don't think that as long as you're disciplined on your underwriting and stick to your fundamentals of what you're looking for, whether it be a certain metric on cash or cash flow or the ability to increase rents after stabilization, after you do some construction or rehab. So I don't totally understand the bad debt phrase. I just think that you need to be really careful with making sure you have sufficient reserves. So as you saw this year, March, April, May, June, some states, they were collecting 50, 60, 70% of rents. Other states were collecting a little bit more. If people did not have reserves, they were in trouble, if they had a lot of leverage. So if you're going to refinance or do a HELOC or anything like that with properties that you have to suck out that equity and then put it as a down payment, you need to make sure you have sufficient reserves. And that would be my big.
Seems like we're having a mic.
We're having mic issues, huh?
Mic check 1, 2.
Can you guys hear Chris, the guy in the red? Huh. All right. Well, we'll switch to plan B here. We will switch.
Have a backup.
All right, Terrance, say something.
Hello.
All right, well,
That work?
all right. Can you guys hear Terrance now in the black?
Hello. All right. Well, we'll talk as if they can hear us.
Yeah, we'll just assume. Good thing is this is being recorded. Yeah, this new mic should definitely be working here. So let us know how the issues are. All right, let's just take.
Is there any way for us to check on our end?
Are you logged in? Can you hear our audio, Zach?
There's going to be about probably a 15-20 second delay before you
Okay.
guys asking before they relay.
Yes.
All right, we're saying
Well,
yes.
Yes,
All right,
yes,
guys.
yes.
Give us a second here to maybe change one more setting.
They said all good now.
nice.
So let's increase the mic volume. This should probably make the difference. All right, guys. Sorry about that. We were in here early this week rebuilding the studio, and everything came unplugged and plugged back in, and not get plugged in correctly, I thought. All right. So let's start from the top here.
Start from the top.
You had really good answers there.
Thanks.
All right. So this is a question here from Jack, who emailed this in before. Jack says, I really enjoy the live Q&A. I have a buy and hold model on once the property cash flow reaches 20%, which is the next down payment of the next building, I will leverage that into another building. Given this trajectory, I will eventually become over leveraged, and even good debt will become bad debt. My question is, what is a good debt to income ratio in multifamily investing? And is that the best metric to use? So repeat what you said.
It's a well thought. The first thing we said was, Jack, that's a well thought out question, and something a lot of people should be thinking about is how much debt, should they have, and when is it too much debt? My first response was, we have to define good and bad debt. So bad debt would be taking a HELOC or any kind of leverage and buying shoes, jewelry, cars, boats, anything that's depreciated in value. If you're going to take debt or leverage from a bank or any institution at 3, 4, 5% interest, and you can deploy it in assets, in this case, real estate, that generates 6, 7, 8, 9, 10% return, that's good debt, right? You're positive arbitrage. You're making money based on what you're borrowing and what it's returning. So I don't know that if you're buying multifamily with a disciplined formula, if it's ever going to be bad debt. As long as you're disciplined, you should always be making money. Now, the catch to that is that you have to have reserves for situations like 2020 when people are not paying rent and you have leverage on top of leverage. That is where you can get in trouble. So you have to make sure that you're very disciplined and you have sufficient reserves. You know, what we underwrite is $250 per unit per year to make sure that it covers anything that happens, you know, CapEx with the property. Now, on top of that, we probably have an extra 1,000 maybe per unit that are in reserves, that in case people aren't paying or there's delinquency or there's a pandemic, that we can cover a year's worth of mortgages. So that's kind of my model, is that I want to know that if something happens and people don't pay rent for an entire year, that I can cover all the mortgages, and we have that in the bank. So that's the way we've done it. To answer the question for my model is we normally have about 60% of debt on our multifamily properties. And that's, you know, that's kind of my personal comfort level, but everyone has a different level of comfort for how much debt they want. I think the key is to stay disciplined and to make sure you have CapEx reserves as well as reserves to cover the mortgage if people are not paying rent for whatever reason. That's kind of a worst case scenario.
So I think one of the issues I'm seeing here is with your assumptions. And I'm not sure I'm quite understanding the question. You say, hey, once my cash reaches 20%, I go out there and buy another place.
Mm-hmm.
And so this sounds like you're doing it very much like, I'll say, a straight line assumption model. You're going to a spreadsheet and say, hey, if this, if this, if this. Well, the thing is, Terrance, when the property reaches 20% cash flow, go out there and buy another property, that cash flow doesn't stay static once you buy it. You fast forward a couple years, hopefully rents have raised, hopefully you paid off more debt. So I'm having a hard time seeing how, if you follow that model, how is that becoming over leveraged as you go down the road? Because there's so many other variables in there. That's where I got stuck in this question. Am I missing something?
Well, that's where I was saying, I think he's looking at debt the wrong way. Is if he's taking leverage from equity that he's created, that's not necessarily bad debt, as long as he's investing it in a disciplined manner into properties that are cash flowing. I think the bigger question is, how much debt should you have in multifamily for a portfolio when you're doing different strategies? Maybe one's a BRRRR, one's a buy and hold. My response is, you have to make sure that you have enough money in the bank, not only to cover things that go wrong with roofs and boilers and siding and foundations. You have to have enough money in case people aren't paying rent. So I think that's the question he's really asking, is how much leverage should he have across a portfolio that he's trying to build?
And so you're saying leverage is not as important, but cash in the bank or reserves in the bank is the more important metric.
Exactly, because in multifamily, if you're getting debt, you know, today's rates 3 or 4%, and you're buying properties in most markets that are 6 or 7% cap rates, which means that should be your return annually, which means your cash on cash should be more like 8, 9, or 10 on the cash you put down. You should never really be in a bad spot as long as you have reserves and money in the bank. So if you take money at 4 and deploy it at 8, you should always be in a good spot as long as you're keeping sufficient amount of reserves and a rainy day fund for mortgages in case of a pandemic, for instance.
Makes sense. All right. Well, Jack, thank you.
I hope that answered your question, Jack. Anything else? Shoot me something else on LinkedIn. I think he said the times aren't working for him, so he likes to watch them after hours, and he sent me in a question. So that was great.
All right. Question number 2. I think this came from LinkedIn as well.
This was Instagram.
Oh, Instagram. All right. So Justin C says, hey, man, hope you're doing well. Had a quick question for you. On a few of your Bigger Pockets videos, you mentioned that a company does the staining of old tile, tub, showers, countertops, etc. for you for around $100 to $125 per product. Are these companies a traditional painter or something else? Also, what kind of product are they using?
Justin, I love that you're watching the construction side and really trying to apply it to your personal properties. I think that's awesome. That's one of the reasons why I love doing this, is helping other people solve problems that I'm running into myself. So what I responded to Justin with was, the same companies that stain bathtubs and normally there's companies like that all around the country, can stain. It's a very similar product that stains countertops and the tile on the walls. And these are normally 1960s, 1970s built that have the 6x6 or 12x12 bathroom tiles on the wall, have an outdated porcelain tub, and then just beat up laminate. And they can use a very similar product to stain the rest of the countertop and the tile in the bathroom. It's a different variation of what they use in, for a bathtub. And it is very potent. We actually don't enter the property for 24 hours after it's applied. So you got to be really careful. You got to make sure you have someone that knows what they're doing. But it is the same company we use that does the bathtubs, does the countertops and the tile.
Is the staining the same as just glazing? Like glazing
exact same thing. Yeah.
Okay,
I'm using the same term.
Okay,
yeah.
so staining. Okay,
Yeah.
so just same. So a company that can glaze a bathtub, and there are a bunch of those all over the country. Talk to them about glazing.
They can use and if they're not aware of it, they can use the similar product. It's just different colors, right? Whatever color you want, especially for countertops, and it does essentially it stains a countertop and the wall tiles in the bathroom and makes it look brand new. And the countertops to me look like granite. They don't feel like granite, but they look like granite when people walk through.
How's the durability on those?
We haven't had them long enough to tell, but for the price, I mean, even if we had to re-stain it every 2 or 3 years, we would come out way better than
just
installing new
granite.
granite.
Yeah.
Especially for C plus properties. I mean, I think it's perfect because they're going to get beat up no matter what.
Yeah. All right. So that was a question from Jack. Let's see, in upstate South Carolina. All right, Jack. So yeah, look for tub glazers and then show them the YouTube shows off the bigger pockets.
That's right.
And point to what Terrance is doing. All right. So guys, keep the questions in here. We're going to start going to the live questions in YouTube. So Kyle says, I'm having trouble finding lenders for a duplex I purchased in Illinois for $62,500 in cash. I purchased it outright, has about $1,050 in monthly rent, no rubs. I'm having trouble using it as collateral. So $62,000 duplex, having a hard time finding a lender to do it. So what advice do you have on there, Terrance?
When I first started buying in Des Moines, Iowa in 2016, we owned several duplexes, fourplexes, 10plexes, maybe like 7 properties in total. We had bought them all cash, and we were getting similar returns. I mean, you're collecting $1,000 a month, so $12,000 on 60. That's something like 20%, I think, cash on cash. So you're getting a great return there. We were doing something similar in Iowa, and I lived in Denver, and it was really difficult. Banks basically didn't want to talk to me. Even though I'm from Des Moines, I had family there. Because I wasn't living there, banks were pretty concerned about that, and they wouldn't touch me. So what I had to do is I had to go get a larger guarantor that had a much bigger balance sheet to personally guarantee on the loan with me. And then we were able to get our first refinance done. And it was like a portfolio loan. So it was a local bank that took all the properties. They gave us one mortgage. They took the first position in all of them and a PG for myself and the larger guarantor. And that's how I was able to do it. So if they're not approving you, Kyle, what I would do is find someone with a larger balance sheet than yourself, structure a deal where he gets maybe a percentage interest in the property for basically doing nothing, just signing on it. And maybe you have to spiff him over a certain number, a percentage of the cash flow as well. Maybe, maybe he takes $5,000 a year. You might have to get creative. In my situation, we owned 100 units at the time. And so I had to give someone interest in the portfolio in exchange for him signing on all of the notes. And maybe it's something where he gives you some cash to go buy some more properties in exchange for signing on more notes. But there's a lot of people with large balance sheets that love that kind of structure. And that's what I had to do. I think start with the local bank, whatever city you're at in Illinois, find a local bank that knows that area, understands rental properties in that area, and then find a larger guarantor. Those would be the 2 pieces of advice I would have. And I've been in that situation. It's very frustrating.
And 2 things I'll add on to there is, make sure you're not just talking to like 30-year conventional lenders. Because a lot of times people, I've talked to a bunch of lenders and they've called, 10 lenders. They've called Quicken Loans and Bank of America and all these banks that, hey, if you're going to do a 30-year loan, great. They're going to give you a great product. But a local bank will have different products. So make sure you're talking to local banks that can do a portfolio loan, as Terrance said. The other thing, because I've seen people make this mistake, is whenever you buy something, whether you're buying it cash or buying it to BRRRR, always already have talked to lenders to see what your takeout financing options are. See, a lot of people get burned in burr properties. Oh, I bought this property, and they get a hard money loan, and they can't get the takeout financing, and then it's a bad place to be.
Right.
So always already go talk to lenders, know what your takeout financing is before you purchase it.
That's a good point.
Yeah. So I know it doesn't help you very much right there, Kyle. But hopefully talking to some local lenders can help you out, or use Terrance's idea to get in the guided personal guaranteed, or go private money, or find some people with IRAs that want to lend it out and give you a return, and maybe do it that way as well. Just you'll have to get creative and start shaking trees.
Mm-hmm.
And that would be a really good question for the forums and Bigger Pockets as well, if that doesn't help you out. All right. So let's go with Ann. Probably help if I actually show the questions, huh?
Yeah, let's do that.
All right. So Ann says, when calculating property manager costs for multifamily units, do property managers charge per unit or per complex? And what would be some average rates, for example, for a fourplex?
I've gone through this a lot, Ann, so I can give you my experience on property management. It depends on the market, depends on the class of property and the location. Rough numbers would be, normally property managers in today's market are taking between half, this is for leasing, half of first month's rents to the first full month's rent for leasing up a unit. So if the lease rate is $1,000, they're going to take between $500 and $1,000 to lease it up for you. And then on rents collected, they're going to take anywhere from 6 to 8% of rents collected. And you should make sure it's rents collected, not pro forma rents. So they get paid based on what they collect every month, so that your interests are aligned for them to go and collect the rent and make sure that the tenants are paying.
You've had property managers right in there that they'll collect on pro forma rents?
Or on potential rents. I mean, I definitely heard, I have had, they can put that in the language, and then you have to correct it.
That's a really good point to clarify.
There's a lot of mom and pop property managers that are doing all kinds of things around the country. I just think, property management is one of those things that's ripe for disruption, just because it's so fragmented, and there's people that have that have been doing it for 25 years a certain way, and still everything is on paper. And then there's new technology coming out, and there's companies doing it, with a lot more efficiency. So there's a lot of disruption there, and there's a lot of things that are outdated and antiquated. So you never know what you're going to see. And it sounds like this, is maybe your first property, and so you're not really sure how it should work. So you want to make sure that you're very detailed with that contract. You want to, I think that what I've done on the leases is, the more that they can get, maybe give them a higher percentage of the first month, try and keep it closer to half. But obviously, if they can get you more money in rent, paying them a little bit more is only going to be better for you. And then definitely make sure that it's based on rents collected every month. And the other thing is, if a tenant they put in, they have to replace in the first year, you should not have to pay the lease up fee twice. And actually, you should try and do it for 2 years. If a tenant is going to leave inside of 2 years, they should have to replace that tenant for free. And those are just some of the nuances that I think will help you and protect you when structuring that agreement with your property manager.
And before you even buy the place, go out there and talk to property managers and get rates.
Yeah.
You quoted 6 to 8%. It's not common for brand new people. It might be 8 to 10% for the property management fees, because the more units you have, you scale down.
Right.
But if you're brand new, and depending on how they structure it, some property managers will charge a lower lease up fee but a higher monthly expense. May be benefit for you, not. But as Terrance said, read the details on there. The other thing on property managers that you may think of when you're talking about the pro forma rents, Terrance, is see if they mark up the maintenance repairs cost. Because a lot of property managers will just, hey, if they spend $100 to clean the HVAC, they'll charge you $100. Others will then charge you a 10 to 20% markup on there. And I think that's BS.
Oh, yeah.
And that also really eats away your returns as well.
Yeah. Trip charges. Watch out if they're trying to charge you trip charges. I mean, I think a rule of thumb is the longer the contract, just be really careful. I've had property managers send me 10-page contracts, and I'm like, listen, there's no reason for a 10-page contract. Send me 2 pages. It should be very simple. They're trying to charge trip charges. They're trying to mark up the maintenance materials, paying the utilities they try and mark up. So just be really, really careful. The more fees that a property manager is trying to charge you, I would run. You want your interest to be aligned, that the more money they make you, they can take a little bit larger percentage. And you really want to keep it that simple. Yep. That the more money they make you, you're going to pay them a little bit more. Hope that's helpful, Ian.
Ooh, here's a interesting question. Santiago, I'll begin my business degree soon. Do you find a business degree applicable and worth it for real estate investing? Maybe the university will get me a good job that could fuel my future portfolio. So the reason I picked this question and got a little excited there is because this is a topic Terrance and I talk a lot about, especially after you've had a couple beers. We talk a lot about this and complain about the education system and talk about some loftier goals. So my answer to that is no, I don't think it will. Can help you get a good job? Absolutely. It's going to be a difference maker if you get into real estate. I don't think it will. I'd almost say it's close to 100%. It's not going to make a difference. What will make the difference is your attitude, your drive, your ability to go out there and network and just make stuff happen and willing to, hey, pay your dues, put work in, have some patience, put away for 10 and 20 years, but your degree. I mean, when I hire people, when I look at people, I don't care about their degree.
Right.
I mean, unless it's a high level, like, hey, you're my CPA or you're a financial officer. Yeah, I care about that. But generally speaking, I don't think it will.
Yeah. Yeah. Attorneys, engineers, doctors, there's certain things that require a higher level of education and training. And one of my big pet peeves and one of the things I'm really passionate about is just killing the story that you have to go to college to be successful and get into debt. My brother and sister were in 6 figures of debt. I have a lot of friends that are still paying off college loans. I went to a private Christian school here. Thankfully, I was on a basketball scholarship, but I had friends going to that school that were racking up $25,000 a year in debt.
Ooh.
The problem with college debt is that you just when you're signing the loan docs and you're 18, 19, 20, you have no idea what that actually means. You don't have enough perspective to understand what $100,000 is and how much time it's going to take you to pay that back. And, one of my passions is just talking about apprenticeship. Go learn a trade, go work for an electrician, go work for an HVAC company, go work for a plumber, go work for a carpenter. There's so many other things that you can do to master, and these trades are making hundreds of thousands of dollars a year. And if you're really good and know how to market and, have other people under you and train them, you could be making much more than hundreds of thousands of dollars a year, because we're at a labor shortage in our country. And we're at an oversupply of kids getting out of college with 4-year marketing degrees that can't get a job, or their job is $30,000 or $40,000. So I love education. I'm always learning myself. I'm always trying to surround myself with people much smarter than me. But I think there's a difference between like educating yourself and having a skill and being the best at what you do and mastering a craft than going to school and getting a degree and then having no real plan after that to create income to pay off that debt. And that's one of the beautiful things about real estate is it doesn't matter what your last name is, where you're from, where your family's from, your net worth, your last name, how many letters you have next to your name, if you have a JD, a B, any of that stuff. If you just hustle and apply yourself, you can do whatever you want in real estate. And so I'm not telling you not to go to college. I'm just saying there are other ways to create income and create a W-2 job that banks will still lend to you. And then in your spare time, learn the hustle of real estate and be able to do that. So that's my personal opinion. I know even my wife disagrees with me, because I don't even want my kids to have a college fund because I just want them to, at the end of the day,
at home I do that,
at the end of the day, it's about creating value. Creating value is about solving problems, and I'm not sure their educational system is really doing that. That's kind of my 2 cents. But I just think if you want to be great at real estate, if you want to make money, you don't have to have a college degree. You just have to hustle, apply yourself, be disciplined, network, and just outwork everybody else. And it's not sexy, but it's definitely worth it. It'll create a lot of freedom.
And if I could go back, almost 20 years now and tell myself now what I know and what my career path, investing path is, I would say, yeah, you could skip college.
Yeah.
Now, college, 2 things. I had a lot of fun in college.
Right.
I also had no debt, but also in college, I think this is 2 similarities. We both started businesses.
Right.
During college. So we used the time we had between college and other stuff. Like, hey, we had our fun, but we also both started businesses,
right,
which helped us graduate into doing other things, get a job, which lets us get into real estate one day as well. Okay. So yeah, you don't need to go there. It's not going to be a difference maker.
How did you have no debt?
Well, I went in state and got a.
They paid for it?
Yeah, they paid for the first 2 years, and I was still going to college right before college's expensive enough. So it was like $10,000 a year last 2 years. So my parents fortunately paid for it. Yeah, cool. So that was I was very fortunate about that.
Yeah, the big key for me is the debt. I think college is a great experience. I heard an attorney I met with a year ago said, you go to college to learn how to learn. You're learning the discipline of studying, of reading, of applying yourself, of being able to retain information. That's really what college is about. Because when you get out, any job, you're still gonna have to relearn, and there's a whole learning curve on any job, regardless of your degree. So I'm not against it. I'm really against the debt. And most kids can't go without the debt because it's $40,000-$50,000. I mean, to go to almost any state school. And that's what I really think is flawed in the system versus going to work for somebody in a field that you really enjoy. And by the time you're 22, you've made money, you have no debt, and you're really good at one thing that will help you create value for the rest of your life. Santiago, hopefully that helps.
Yes. All right. Kyle says, I own a duplex and I'm closing on a quadplex. I find the front end work to be about the same between the two. At what point does a front end deal work become different than your average deal? So this sounds like almost like
work is.
Well, I think the point of scaling, like, hey, to the amount of work it takes to buy a duplex versus the amount of work to buy a fourplex. Dude, we talked about this a lot of times too. I mean, you said this earlier. It's like, I mean, I'm gonna paraphrase what you told me earlier this year. It was like, hey, we're doing, 20, 30, 40 complex. I realize it's not that much work to put a couple more zeros behind and do a 90 unit or 200 unit complex. I think it's that same message on there. It's just like, hey, it's not that much work to go bigger and scale. That's why I read that question.
Yeah, I'm gonna sound a little bit like Grant Cardone, Uncle Grant here. And I'm not Grant Cardone. I really agree with everything he says, but in this particular instance, he is right on. And you're finding this out, Kyle, is that it takes the same work to do 2 units as 4, and it takes the same amount of work to do 4 as 8. And what I've learned is that it takes the same amount of work for me to do 20 units as 200 units. And so, when Chris and I are talking about goals and planning, I'm just trying to be more intentional about focusing on larger deals because it takes about the same amount of time to underwrite it, same amount of time to get the debt, same amount of time to raise the money, but your payoff is 10x, right? Or even more than that sometimes. But you have to start. But the catch to that is that it's hard to get to 200 if you've only done duplexes. It's going to be hard to get the money. It's going to be hard to get the financing. So there is a rub there, that you have to have the experience, you have to have the relationships, you have to have the track record, you have to have the balance sheet. There are some things you kind of have to cut your teeth and pay your dues on doing that. And for me, I started doing flips. I was flipping houses for 4, 5, 6 years, and then I got into smaller multifamily. And then just now in the last 12 to 18 months, have I been able to say, hey, you know what? I could qualify. I can get this done at 200. Why am I still working on 40, 50 unit deals? I should be doing 100 plus unit deals every quarter. And that should be my focus. And so part of it is you have to pay your dues. You have to learn it. You have to be proven with a certain number of units. But do I think that you should be working on an 8 unit? Absolutely. If you can do a duplex and a 4plex, you can do 8. And you're doing a couple 8s, you should definitely be working on a 20. You do a couple 20s, you should definitely be working on a 40. And you're doing a couple 40s, you should be definitely thinking about 100. But I think you have to, there's stepping stones. And so you can't skip steps, that many steps. But I do think you could go from a 4 to an 8, 8 to a 20, couple 20s, go to a 40. It's the same systems and process, just a little bit more detail, a little bit more nuanced. And I think you're definitely on the right track.
And I mean, there are the break points in scale. Like, hey, to do this, like, hey, if you go to 4 to 5, that's a different world. Hey, you can learn it. It takes more time. But hey, you're going up from 10 to 100 units. It's going to take a different type of staff. You need to research. Right. Exactly. Said. See, there are points to do that. Whether you're investing or business, there's always, hey, to do this, we have to get the staff. But once you get this incremental knowledge base and maybe smaller overhead, as Terrance said, then you can 5x, 10x, 15x it off of there. But there are all those step points you have to meet. And one of the things I think this is something that I heard from Brandon Turner recently. He's saying one of his goals, and he called it the stack method. I might be confusing methods, or he's just every year he goes to, he tries to buy a bigger unit. He buys a duplex, then the 4plex, then 8plex, and 16. Always just, hey, go bigger and scale up something level, next level.
Notch, yeah.
And that's basically the same thing you're saying. We're saying call what you want, but that's a really good way. Like, and Brandon's got the great messaging on there. But that's a good idea to have. But from a fundamental level, you're absolutely right. There's not that much of a difference.
Yeah, that's great that you're realizing that. And I love to see that light bulb go off because I've had it numerous times in my career, and it's game changing. What's John Matthew Antonio talking about here?
Where is that one?
Right there.
Oh, well, So he says, should I break my lease and buy a house hack? I currently found a deal with a 41% cash on cash return. So I'm having this conversation quite frequently throughout the week since a lot of my clients are house hackers. Comes down to basic numbers. A lot of times for most of our clients, they break their lease. It might be $1,000 break lease fee and then 1 month's worth of rent. So they might be out $2,000, $3,000. Another client who's actually actively looking for a duplex to house hack right now, her lease break fee was like $10,000.
Wow.
So yeah, I mean, it's just one of these.
She had to pay the whole year's rent.
I don't know. It was just some insane amount of number. And she's a lawyer. She's like, it's legit. Like she goes, it's BS, but it's legit.
Wow.
And so then what she did, she actually renegotiated lease to go from an annual lease to a month-to-month lease. So her lease jumped up like $300 a month. Now she would break it at $1,500 instead.
Wow.
So really understand what your lease break fees. It comes down to basic numbers. Hey, number one, do you have the cash reserves to buy the place and cash reserves to make sure it's a good move? Don't rush it. Don't force it. If you're house hacking, you're probably young, so you got time on your side. Look at the numbers. Hey, I can buy this house that's going to be a 41% cash on cash return. And I'll buy a house, which starts my compounding of interest effect faster because I own a house. Oh, but I have to spend $2,000 to break the lease. Makes sense.
Right.
Oh, I have to spend $15,000 to break the lease? May not make sense.
Right.
That's how I look at it.
Yeah. I love the idea of being able to do that, get into something, build your equity, get out of renting, thinking about home ownership. I just think you got to wait for the right time, the time that it's not going to be expensive, the time that you have the right deal, the time that you're, the W-2 and everything matches up to get the financing. But there's no doubt that you should be thinking about it and looking at it and analyzing that. And as soon as you can do it, you should do it. I mean, it's life-changing to go from paying someone rent to owning a property that people are paying you rent. I mean, that changes the whole game.
Yeah, it creates a huge mental shift.
Oh, for sure. Huge.
Yeah.
So I definitely encourage you to do that. Even if it's not 41%, even if you have to wait, it's still going to be net one of the best decisions you've made.
So I think it's a follow-up question from the first question we had from Jack. Kind of a random one here, but JF says, what is considered a reasonable return for someone lending from their IRA? So I don't lend from my IRA, but I got friends that do it.
Yeah, I lend from my 401k. You have to define what they're lending on. So if it's the first position, if the question was,
let's go back to let's use this this duplex in Illinois for $60,000. You probably can't get a lending. So if someone's going to lend him, I don't know what, a 75% LTV on there,
and they're going to have the first position, 4 or 5% is pretty good. It's better than you're going to get in a money market. It's safer than the stock market. So if you gave someone between 4 and 5%, paid them monthly interest, and they have the first position at 75%, that'll be the safest bet they make that entire year. And for you, you're getting some cash back that you can go redeploy, and you're paying, you're probably not going to have to pay an appraiser. You're probably not going to have to pay some of those other third-party closing fees. So net, you're going to be in at a really good rate. So I think 4 or 5%. Now, if it's the second position, so if someone's lending you money out of their IRA for construction as a HELOC or anything like that, that's a little bit riskier. I think you need to be, reasonable is going to be between 8 and 10%, maybe a little bit more. It depends on what you're going to do with the money and how great of a return you're going to get to what you want to pay. But 8 to 10% is reasonable for a second position and something a little riskier. Now, if it's the first position at 75% or less, I think 4 or 5% is fair both ways.
So 2 things pop in mind while you were saying that, Terrance. One is, a lot of like hard money lenders, they will raise money from a lot of people to IRAs to then go turn around and lend it out. I know a couple around town, they pay their investors 8%. So those can use as a benchmark. The other thing, I bought my very first property. Don't know if it's technically from an IRA, but it's actually from an older friend or a friend's parents. This was after the crash, 10 years ago. And they give us a 5% loan at 15 years. And that was from their, trust, basically same thing. And 5%, and that was a killer deal for us.
Right.
And there's a great deal for them because, as Terrance said, it was secure. It was 100% financing too. 100% financing at 5% for 15 years.
Oh, they did. Wow, that's incredible. Yeah. Because the thing with hard money, and the reason why they're able to pay 8% is it's a little riskier, right? Because they're lending at a much higher leverage. But if someone's going to give you 75% of the value, 5% to them is a really generous deal. I think you might be able to get it less just because there's no other way to get secured income out there. I mean, the Treasury is paying 0.8. LIBOR is at at 15 basis. I mean, there's just that's the big issue right now because debt is so cheap. There's nowhere to find consistent income every month in the market. So in real estate, to have something that you have 25% equity of your own equity in, that's killer for someone. I would do that. If I had the first position and someone's gonna pay me 5% a month, I would take that all day.
And keep in mind, with the IRAs and private lending, there is no centralized system. There's no, hey, this is what everyone's doing. You talk to 10 individuals, you'll get 10 different rates of what they're offering. So talk to lots of people and, ask for numbers. Right. If you got a number in there, cool, ask for 5% and see what you can get.
Yeah.
All right, Terrance, what looks good to you for questions?
If you go up there, what's Jose's question there?
Jose
Barbosa.
What is a good gross income multiplier ratio to buy rental? So gross rent. So what is a good GRM? What is a good gross rental multiplier? I think is the term gross income. Yeah. GRM, I think is what I'm reading on there. So I don't really use GRM.
Mm-hmm.
Do you use GRM?
I don't, but a big back of the napkin for me is I will take, I'm normally buying properties cash and they normally need a lot of work when we're talking income producing properties. So I'll normally look at what is my total cost basis. So if the purchase price, let's say I'm buying a fourplex for $500,000 and I'm going to put $100,000 into rehab. So my total basis is $600,000. And then I look at what is the rents? What are my total rents for the year? So if rent, let's say the rents of the fourplex, let's say they're $1,000 each a month. So $4,000 a month, 4 times 12 is 48,000. So I take 48,000 divided by 600 and I see what that number is. And if it's better than an 8, to me, that's something that I want to look into. And to me is like 90% of a deal. Obviously I still have to do an inspection. I still have to do some other things. So you take 48 divided by 60. Yeah, you're at 8 right there.
Well, that's GRM, right? Yeah, that's GRM.
There's not another step for GRM? That's 8%.
Yeah, no, that's it. You take the annual rents divided by. Now,
I do my total basis.
Difference, and I agree with you here, is a lot of people say purchase price. You got to do purchase price plus rehab costs. Yeah. Because if you're calculating, hey, I'm getting these rents,
right,
you have to factor in your total cost to count those rents. So right. If by textbook definitions, they won't do that. But I agree with you underwriting. Like you include your purchase price plus what you have to invest to get those rents.
Yeah, I just include my total basis. That actually, the construction actually includes holding cost as well. So if I'm using a line of credit or I'm using private money, I include that. So whatever my total basis is, so purchase, construction, holding cost, blah, blah, blah. And then I divide the total rents, and I'm conservative on that, gross rents divided by that number. And if that's an 8 or better, normally that for me is the green light to say, let's keep looking at this. If it's under that, after you add expenses and taxes and all these other things, it gets to where it doesn't make a lot of sense. Debt is so cheap that anything 8 or above, I think you got to take a really close look at. This is Denver, right? This is Denver. At Des Moines, it's got to be over a 10 on that gross multiplier. But that's kind of how I back of the napkin. If someone's just, I look at deals maybe 10 times a day. So just for me to sift through them.
That's your high level.
That's a high level thing. Yep. It's like, is this a deal?
And this is the inverse of the 1% rule in bigger pockets.
Right.
It's just the inverse of that, because if you're getting a 10 in Des Moines, that's 1%.
That's 1%.
That is what numbers you did there for Denver. That's a 0.8%.
That's right.
So it's basically it's just an inverse, I think is the right word, of the 1% rule.
And that includes, the 0.8 actually includes construction and holding costs, so total expenses. So that's, in my world, that's a deal that I look at a lot closer.
Yeah. All right. Good question, Jose.
I love where your head's at. That's the right way to think about it. What else we got here? We got a lot of questions. What about?
Oh, here we go. This is a quick shot that Greg said when we were talking to I think it was Santiago earlier about. He says, "Hey, I'm an electrician with 5-year experience, making 6 figures." Boom. That's exactly what we're talking about.
Greg, yo, mama. I like it. That's right. 6 figures and probably very little debt.
Oh, here's a good quote from Duckbow. Hard work plus uncommon skill set plus saving plus investing equals success. That is
it's a good formula.
It's a great formula.
Success or just freedom. That's ultimately what people are trying to buy is time, right? That's the money. The more money you have, the more time you can buy. Freedom. get out of the rat race?
Okay. Edgar, I like this. Let's give a specific action plan here. What step-by-step advice would you give to all 18 to 20-year-olds that want to possibly become financially free by 30? So the basics of obviously, live below your means. If I knew what I knew now, I would house hack all day long. House hack, that way you can buy a house, live in it. And whether it's a multi or house or just house hack, and at that 1 year mark after the lender allows you to move out, go buy the next one. Mm-hmm. Keep buying, repeating. I would do that. And I equate that. Is that going to make you rich in a couple of years? No, but give it 10 or 15 years and it probably will. But I can consider that to, it's a very safe way to invest in the market. Do that while you're working on a skill set to work on an active real estate business, whether that's becoming a multifamily operator, becoming a realtor, becoming an electrician, whatever your interest and your skill sets align to there, definitely do that. Like, don't focus on a job or business that you hate. Focus on something that you're interested in that feeds into you doing more real estate deals and bigger real estate deals. Yeah. That'd be my, two-step formula.
Yeah, I love it. Yeah, I don't know how many steps I have, but I think the general ideology should be, I'm going to do the opposite of what everyone is thinking they want to do. So, I wouldn't spend money on clothes. I wouldn't be focused on clothes, going out, even taking really nice trips, buying a nice car, dating. I think in my 20s, I made a bunch of mistakes. I was driving a Range Rover. I was spending a bunch of money. I had started businesses and I had made really good money, but I just didn't really understand how money worked. So I spent almost everything I made, which was ridiculous.
Lifestyle inflation.
Yeah,
I did the same thing.
Yeah, it was totally, and looking back, when I look back, I'm like, man, what was I could have bought this. I could have bought that. I could have been buying apartments. I could have been buying apartments in 2007, 8, 9, 10 if I would have, I just didn't, I was just so focused on doing all these other things versus being really financially free and being a good steward and really the punchline for me was I didn't really understand how money worked. And if I would have understood it, you can definitely buy those things in your 30s if you invest well in your 20s and it doesn't change your lifestyle and there's no opportunity cost. And instead I took the principle that I made and wasted it. So, a big thing for me is just, saving, living really frugally. And doesn't mean you can't enjoy and have fun. I just think you got to be really careful about, making sure that the majority of your money is going into either a business or real estate or being reinvested. If you're spending money in your 20s, that means in your 30s, you're gonna have to work twice as hard when you're married and have kids, versus if you take the money you make in your 20s and invest it, you're gonna be able to live off of that for the rest of your life, which is what, I've done the last 6-7 years, the money I've made, I've reinvested, and now I can live off of my investments and I don't need to really make any money. And that's where and I think, Edgar, that's what you mean by financially free by your 30s, is that every month your expenses are covered by the investments you've made.
And if you want more details on there, two great books, Set for Life by Scott Trench. That is not so much a real estate book, but just a general overall financial blueprint. That is one of the best finance books, finance life planning books, because it's very. He did a really good job with that book. Yeah. Read that. Read House Hacking by Craig Curlop. Those two messages. A lot more detail than what Terrance and I just talked about. Same stuff, but that's just great stuff right there.
Yeah.
So I would do that. And the reason I had that answer is I was actually on a podcast interview and someone asked me that 3 weeks ago, and I gave a really bad answer. And I realized after I hung up. And then you asked that question, so I'm very glad, because that's what I would have done.
You got a second shot at it.
Yeah, I would just house hack my 20s and not been stupid with my money.
King Rob, you want to go down to King Rob? Down there.
Okay, we'll do that. And I got another one.
Okay. Cool.
I want to do the one above it next.
Okay.
All right. So King Rob, how do you find a hard money lender to fund your deal, and how to avoid using your cash to pay for all the cost? So, talk to all the hard money lenders, and they're all going to have different rates and terms,
right, and
profiles for who they'll lend on and what they'll lend on, and different hard money lenders have different types of things. This took me a while to understand. One hard money lender I used, I put 10% down, and I got a lower interest rate. I could have gone with another hard money lender down and put 0% down, a higher interest rate. But the 0% down higher interest rate actually made me a higher return because I had no capital in there. So realize different lenders, they all have, high level of similar returns, but they all have different nuances. Hey, some will fund 100% of the purchase price and 90% of the construction cost, or vice versa. So talk to a lot of hard money lenders, but come with them with your personal finances and the ideal deal you're looking for, and give it to them. If you go in there without a clear message of what you want, they're not gonna be able to tell you what you want. So go in there with a one sheet that you can read it to them and then email it to them and can say, here's what I'm looking for, here's what I want, what can you give me? Or how can you help me?
Yeah, that's a really good blueprint. When I read your question, what I hear is you're looking for one. How do you find one? And I think one of the best places to find hard money lending, regardless of your market, is Bigger Pockets. You can go on the forums, you can go on the marketplace, and you can just post, hey, I have this kind of deal, or I'm looking for this kind of deal. I need a hard money lender. Can someone connect me? I mean, hard money lending is one of the most populated spaces in real estate right now. I mean, if you just Google hard money lending with your zip code, you're going to get 25, different companies that pop up, and you're going to start getting spam in your Instagram and Facebook, and you're going to start seeing hard money lending pop up everywhere. But I think to find legit, trusted companies, I think you could go to the Bigger Pockets forum. I think there's a lot of really good options on Bigger Pockets. So I would look at that. How do you avoid using your cash to pay for the cost? So it's going to be difficult. At some point, you're going to have real equity to do a flip or a rental or anything. You're going to have some money.
You need skin in the game.
Yeah, you're going to have some skin in the game to get a loan on anything, even if it's from a hard money lender. They're going to want to see that you have the cash to pay for construction, to service the debt every month.
And reserves.
Yeah. So you're going to have some money. But I think that if you needed a capital partner, you could find that on Bigger Pockets. And you could definitely find multiple options for a hard money lender, in the forums in the marketplace. So I would recommend going to Bigger Pockets and checking that out. You're going to have a lot of options there. That's one of the things that I love about the community of Bigger Pockets is anything you need for things like this, you have multiple options on there.
Yeah.
So go get yourself acquainted with Bigger Pockets and get yourself a profile. And look us up. We're on there.
Yeah. And one of my favorite things with the forum, I got topics like this, is there's that, some of that forum search feature.
Right.
Like that question's pretty much been asked before. Go search the forums for topics, and it's just gold. Hey, go spend 2 hours reading it. And it's lots of good Q&A. I've gotten lots of benefit from that, especially in my beginning career days, was just searching the forums. So Theta Hedge Capital says, I have 10 single family homes, no mortgages. They're all renovated, rented, and cash flowing well. Would you recommend hard money in order to get some cash to scale up? I am not eligible for a conventional refinance. I would say no to hard money. If you got 10 paid off properties, go talk to local banks. Local banks, they're the portfolio lenders. They're the ones that will lend out your own money that Terrance was talking about on a few questions ago, versus conventional, where conventional is the government-backed money. And you either check the check boxes or you don't. But if you've got 10 paid off single family homes, there'll be multiple local banks that will want to lend to you, because they won't just look at that criteria. Hell, you got this, you got this, you got that. Oh yeah, we'll lend to you.
They'll definitely lend to you, maybe at 50, 60% of appraised value, but it doesn't really matter. You're going to get the money at 3.5%, which is incredible. And you're still going to cash flow really well. And it's going to give you liquidity to go and buy 10 more. And you're going to maybe double your cash flow or something ridiculous like that. So yeah, I don't think you need hard money. I would find a local bank, show them the properties, and they will underwrite the properties, and they'll take a first position in the property. So even if you don't have W-2 income, they're going to have the property as collateral, and maybe they only lend you 50%, which is still fine. You're going to have a really low payment, and you're still going to have enough cash to go out and buy 5 to 10 other properties. And I let those marinate, cash flow for another year, and then I would do the same thing. Go get 50% on those and go buy 5 more houses, and you'll have 25 instead of 10.
And with that, I mean, you get individual loans, or just go out there and get a blanket loan, get a
one
loan
portfolio
across,
loan.
Yeah, one loan across all 10 of them, and probably even get better rates and terms.
Yeah, I actually have 65 single family homes, I believe, on one portfolio loan in Des Moines, and we just refied them. And it's super easy. I mean, it took 60 days because they have to go out and appraise 10 homes, but that's definitely the way to do it.
So hard money is for short-term financing, not long-term like that.
That's right. it'll kill your cash flow and you'll be really upset that you ruined your winning hand.
All right. Jordan says, is it okay to start very high at first-time home buying? I'm assuming, I kind of want to get into this because this question comes up a lot. I'm assuming you're talking about in the current market cycle that prices are high, and we're comparing it to what, 10 years ago. So is it okay to start very high the first time? I'd say yes, because what's the alternative? Sit around waiting the sidelines for years? And there's always, you can't just look at price. You have to look at price and lending and opportunities and trends. There's so much more than just price. No matter what the market is doing, there's always opportunity out there.
Right. I wouldn't buy, Jordan, if it were me, my first home, I wouldn't use it as just a primary. I'd use it as a way to create income. We've talked about this multiple times, house hacking. So I think either, a duplex, you can live on one side, rent out the other. FHA for a fourplex or a triplex, you can live in one of the units, collect cash flow. I think as long as you understand what your goal is and you can use the property to create income, then I think it doesn't really matter what the purchase price is as long as you're going to be able to create income. Now, if you're just going to live in it and have a really high mortgage, then that's a different scenario, and I would advise against that for your first home. Find a way to use it to create income.
All right, we got enough time for about 2 questions left, Terrance. Any of these jumping out to you?
Stephen Brown there?
Or Stephen Brown. How do I just quickly run numbers on multifamily? Just know if it's a good deal before reaching out to the seller. I'm mainly concerned about the water bill. County doesn't have anything.
So water, normally I'd talk to the utility company.
Yeah.
So you should be able to look that up. It's a public company and all of that should be accessible, or the seller should have water bills that they can give you.
And the thing is, once you figure it out, it's going to be about the same across. If it's fourplex, it's all going to be about the same. So utility bill, and also, the water bill will be not anywhere near the top of my list to be the biggest.
Yeah, that should be the smallest expense. Yeah. The way to quickly, and we've done podcasts on it, and there's a lot of really good stuff on Bigger Pockets for how to underwrite. Just back of the napkin, you're going to take the number of units and what the average rent is. So I'm going to try and understand what the income potential is. And then based on the location, you're going to subtract vacancy. So in Denver, vacancy traditionally has been 5%. Because of Corona and some other things, maybe you use 7. So you're going to subtract vacancy, and then you're going to subtract all of the expenses. So you're going to get, an insurance quote. You're going to have property management. Normally, property management I inflate to 8 to factor in leasing expenses and other costs that come along with that. So you're going to have insurance, you're going to have property taxes, you're going to have property management, you're going to have reserves, you're going to have maintenance, right? And then you're going to want to see what is that, after you take the vacancy out and all those expenses, what is your NOI? What is your net operating income? And as long as that is, in my market, I'm looking at 6%, but I think a good rule of thumb is 7 if you want to cover, the entire country and say, what is a average, cap rate that you should be looking at, based on the NOI. I think as long as you're getting a 7% return on that, when you take the NOI divided by the purchase price, I think that's something you should look further into. And then you can write a contract, and then you can look at the water bill and some of these other expenses, that you're referencing there.
During your due diligence.
Yeah. But this is just, I think, back of the napkin to know whether or not you should put an offer in and put it under contract, and then be able to go, and then you do a full rent study. You look at every single lease, you look at all their expenses, you look at what they spend on maintenance, you do a full inspection of the property.
And the thing is too, if you're having trouble getting, like I said, water bill should not be your sticking point on putting offers in. I would even worry about that before putting an offer in. Look at comps or offering memorandums of other buildings nearby. If you see a couple of those, you'll quickly realize, hey, this is the average, water bill for this part of town.
Matthew down there, or do you have another one?
Let's do Jerry. Then we'll round out with Matthew.
Okay.
Because this is an interesting question here, and this is a good one to talk about. So Jerry says, what should the NOI or net operating income be on a property per unit? I've seen 4 units generating $50K, while a 7 unit is generating $35K, and doesn't make sense to me. So if you're asking for like a rule of thumb here, hey, every unit should have X or X or percent number of NOI, it's not quite that simple because I mean we see all the time in Denver. There's fourplexes with higher NOIs than the 6 unit, and it could be the layout. Hey, if the fourplexes are 3 bedrooms, 2 bath, and the 7 units are 1-1s, very different types of rents, or Class
Location.
A versus Class C, location, all this stuff. So
renovated versus unrenovated. The things that come to mind is if the 7 unit, you also have to take into account what the purchase price is. So if the 7 unit is outdated and has a ton of CapEx and the owner hasn't done anything to it, there may be more upside there because maybe that should be 80,000 in NOI. So you have to factor in the purchase price when you're looking at that to figure out the total return.
All right, so it's Matthew, right? All right, we're gonna round out here with Matthew.
Another graduate.
Matthew says, what is your advice for a recent graduate with lots of debts? Should I pay off my debt first or get a cosigner and buy multifamily properties? So very loaded question. There's a lot of variables on here. And I mean, give you some context here. So my wife graduated vet school with $200K in debt. So I helped her figure all that stuff and take care of that. And I also helped a lot of her friends kind of put together some plans. So
what was the interest rate?
When she graduated,
4, 5?
Oh,
because they consolidate now, don't they?
Oh, before you consolidate. I know this was she graduated 2011,
and the interest rate was what?
It was a blended of 6.9.
Oh my god!
At 200, it was 198,000 total debt.
Jeez.
And that's all of her friends. So, I mean, first thing we did is we just refinanced the private company to like 4.25. And my rule of thumb, if debt's below 5%, I'm not really that worried about personally. That's my threshold. So you gotta figure out what your threshold is. So figure that out. But figure out what your threshold is. Have cash reserves because no matter what, you have cash in the bank, as we've mentioned 18 times already. But generally speaking, if you're paying 4% on debt, is your money better to go out there and get a 20% plus return on an IRR and a multifamily, or is it better to go out there and pay off 4%? And if you model out in a spreadsheet, you're going to build a lot more wealth by doing 20% returns versus getting a 4% return on paying off your debt. So personally, I would cash reserve, most likely refinance it. And then, how can I pay what I need to do where that sweet spot is for paying off the debt to service it? But then how can I go out there and get these, the great returns we're getting in real estate, which would be like, they should be double digit returns.
Yeah, 100%. I mean, when I sell a property and, we have a property right now under contract and, we owe 2.7, I believe, to the bank, and we're selling it for 6.5 million. So, like a Dave Ramsey would say, oh, you should take that money and go pay off all your debt. And in my mind, I'm like, why would I pay off 3.25% debt if I can just go invest it and make 15 to 16 or 17% and then continue, And so that's been my rule of thumb is if I know what to do with money, I don't need to pay down really cheap debt. I want to take more money and go redeploy it in the same strategy. And that would be my advice is if you have a lot of debt, that's bad debt, like from college or anything else, credit card debt, work really hard at your job and then take that money and go find a partner and you invest it in real estate. And you're going to be able to pay off that debt a lot faster than if you just take your income to pay off that debt. If you invest your W-2 job into real estate, you're going to do a lot better than paying off bad debt. So invest the money well, find good partners, hustle at real estate, and you'll pay off your debt a lot faster.
And the last thing I'll put on there is assuming you're in your 20s. If you heard what Terrance started talking about 20 minutes ago, don't be stupid and get lifestyle inflation. Stay disciplined with your finances because it's very easy to start making money and start spending it. All right. Well, we are up at the hour. So everyone, thank you for your questions. Sorry we can't get to them all. They're lots of fun to answer. If you can't make these live, send us a question. Social media, Bigger Pockets. Bigger Pockets, the main social media site I use. So hit me on Bigger Pockets. Terrance, what? Instagram?
Yeah, hit me on LinkedIn
Pockets?
Or Instagram. Yeah, any questions we didn't get to and you want us to, we'll try and pick a few good ones for the next one. And we can't get to all the questions. There's a lot of great questions. We really enjoy it. And we'll try and get to more next time. We'll be here after the new year.
I think that's the plan. Well, no, we'll definitely be here after the new year.
After the new year.
We're not having any hard dates, but we're
cool.
We got some cool plans in the works too. So you should hopefully see some a lot more content from us with some good ideas as well.
We're gonna have some awesome stuff coming out. So happy holidays and thanks for joining.